You want to buy a business or start a business that has value potential, or maybe it's just safe, or you already have a business and you're really not sure how to increase the value. I mean, that's the question. What's safe, but more importantly, what business can actually grow and actually make more money and have more value? At first, it seems like a very simple answer. It just makes more money and that means it's worth more. But that's not true. In fact, lots of businesses sell at extraordinarily high values that don't even make a profit. There's an actual equation and setup to what increases businesses' value. Something that I learned from starting small and buying small businesses, trying to figure out how to increase the value. I bought businesses that were worth a few $100,000, turned them into over $1 million. And then I grew. And I bought businesses and turned them into companies that have hundreds of millions in assets or are valued at hundreds of millions. And today, I'm going to break down how businesses actually create value. This leads you to understand how to find the opportunities that everyone else is missing. Okay, first and foremost, let's get a quick breakdown of how businesses are valued. We're going to keep this simple and really quick. At the end of the day, it's usually based on a multiple or times, like a multiple of revenue or income. So in a business, you have gross income, which that's just all the revenue that a business may make. Next, you have what's called EBITDA. You may have heard of this before. Essentially, think of it this way: operating profit. EBITDA is profit before debt payments, taxes, depreciation, or amortization. Why that's important? Because those things depend on individuals that buy it, whether they want to put on debt, where they're located, taxes, right? It can depend on lots of things that have nothing to do with the business. That's why people focus on the operating profit to understand how profitable the business really is. And then you have cash flow. Cash flow is how much you actually take home after things like debt, taxes, depreciation. But because that's individual, people don't really look at that so much for value. Now, the multiple. Most businesses are traded on multiples of EBITDA or operating profit. You make $100,000 or $50,000, whatever that number is, of operating profit. You want to sell it. This is where the massive difference in value comes in. You see, some businesses trade at 1x or 1 times the actual operating profit. So if you make $50,000, somebody will buy it for $50,000. Now, others make multiples of 20x. So you make $100,000. They will pay you 20x that $100,000. That's $2 million. So the difference of 1x at $100,000 is $100,000 versus $2 million. This is where people don't understand and where they lack finding the actual opportunities, or more importantly, creating a business that can sell for $2 million versus $100,000. And that's what I'm going to teach you. In fact, I've built out a chart that I'm going to walk through. Okay, so most people think that it's just purely income growth. Now, while that's true and important, it is not only not the only way that you increase value, it's not even one of the top. There are multiple factors that drive that multiple or how much value that business has. This doesn't come down to just simply selling the business. This comes down to dealing with banks, reinvestment, investors, all sorts of things. In fact, most of the time, it's actually more important than the number itself. So let's start out at one of the biggest: revenue type. Revenue type is how you actually make that money. You see, if the business has to always be selling and you never actually know how much money you're going to make until the sales happen, and it starts over all the time, repeated over and over and over again, that is unpredictable. Multiples in value are very much based upon predictable revenue. This is why we see the massive wave that everybody hates, including me, of subscriptions. We live in a subscription life. You have to have a subscription to eat, breathe, and everything. It drives me bonkers. I'm so tired of subscriptions. The reason why all these businesses are moving to subscription models, and you should too, is due to the fact that it creates predictable revenue that increases dramatically the value of that business. It also increases the amount that you need to spend to advertise and operate that business. Why? Because it gives you not a sell amount or net profit, as in I can make this thing for $100 and it takes me $50 to sell it, or $150, and then I get $200 from it. That means I have a $50 profit to a lifetime value. All right, I can spend $200 to make a product and sell that product for $200. Now, at first you're going, well, that's break even. You don't even make any money. But that $200 comes in every single month. Now that $200 sell just turned into $2,000 as opposed to $50. Make sense? The next thing is growth rate. How fast is that revenue growing? So, do you have a stagnant business that is just churning its wheels, or is there predictable ongoing growth, and how much is it? Now, once again, we're dealing with making money. How much, and how fast. The next layer of it is margin. Out of that money, how much do you actually keep? A lot of people make it simple. They go, I can make a widget for $10 and sell it for $20. That means I have a 50% margin. But that's not true at all. You have overhead, you have labor, you actually have to market, you have to sell it, you have holding cost. So what you think is a 50% margin, because you can make it for 10 and sell it for 20, actually may be negative. You may not have a margin at all. This kills countless startups. They believe that they have a 50% margin, and 2 years into it, they're like, why aren't I making a profit? Because of all the things that go into it to sell the product cost money. How much are you really making after not just the amount to make it, but to sell it, operate, run the business? How much are you left over with? A true margin. Now, outside revenue and profit and growth of the revenue, let's get down to the other factor. Once again, these factors are just as weighted and sometimes much more than those. The first is very concentrated, meaning you have a small market, you have small concentrated customers, and there's not a lot to go from there. These are low multiple businesses because there's nowhere to go with it. Also, the customers is in the demographics. Who are you serving? Is there room to press prices? Or are these very price sensitive customers? Now, if you have a large diversified base that has lots of customers that aren't price sensitive, you are going to get a much higher multiple. So think about it like this. You have one-time sales, you have a margin of 10%, and then you have a very low growth rate and a concentrated customer base. You may get a 2x multiple. Now, on the other side, you have reoccurring known revenue that can be mapped out, you have over a 50% margin, and you have a high growth rate of over 30%, and diversified, sticky, good customer base. You can start to get into 15x multiples. But that's not all. The next thing is scalability. Some business models, in order to scale, it is very capital intensive, meaning in order to sell more products, I have to build, I have to get a lot of inventory, I have to have locations, I have to have lots of labor, I have to replicate exactly what I already did to get the same amount of sales. That is not a very scalable business. And it's very capital and work intensive to increase that revenue or customers, versus something that's semi-automated, where you can grow your customer base and revenue by producing roughly the same amount of work. Now you get into other business models that those expenses that are associated with that revenue are really fixed. They're not variable, meaning incrementally, as sales go up, the expenses don't go up at the same rate. Think of things like software. This is why software gets multiples of 20, 25x or more. The next is risk and volatility. High risk, high volatility, unpredictability means low multiples, where low risk, predictability receives high multiples. How much am I paying? How sure am I that I'm going to get a return or even get my money back? The next is probably one of the most important, if not the most important. Owner dependability. This comes down to the structure of the business. Are all the customers reliant on that owner? Is it relationship? Are they there because of that person? If they are, that makes a business get a very low multiple and almost always is associated with that person staying there. Why? Because if they leave, you could lose either a lot or all of the business. This obviously makes it as not a very good opportunity to buy, etc. It also makes it risky for banks and everybody else. What happens if you get hit by a bus? The business is gone. Now, how you offset this is you have operations and management in place where if you were to leave, the business could keep running. This is the area that venture capital and buyers love. The less owner dependent, the higher the multiple will be. The more owner dependent, the lower the multiple will be. Now, also, you can go to my Instagram page and I actually go through businesses and we look at why I would buy or pay a high multiple or why I wouldn't. And finally, we get to the exit potential. Now, every business has an opportunity to sell, but to who is the real question. That pool could be very, very small. That could be localized. You need like a local owner or somebody to buy it, and people that maybe don't have a lot of money. That means there's really not a lot of opportunity to monetize that value. That's a bad situation to be in. As opposed to, there's large pools of buyers that have lots of money that are willing to come in and buy it. You have competition. You have people that are willing to pay. That drives up those multiples. Think about it as selling to a local person that maybe wants a side hustle or wants to come in and operate a business versus actual businesses or people that are adding it to a portfolio, or they want to come in, buy it, expand it, and inject capital into it. They're willing to be much more aggressive. The key is, it's not one of these things, it's all of these things. You could have a business that has half of them, but it is completely owner dependent, and there's no exit opportunities of any magnitude, and you're gonna get a low multiple. Now, by low, it may be higher, like 5x, but it's not gonna get into 15, 20x, and it'll be tied to you. But when you combined revenue type, like where that revenue's coming, how it's coming in, the growth rate, the margin, the customer base, if it's scalable, and what it takes to scale it, meaning are the expenses directly tied to the growth? They grow at the same rate? Or is that not true? The risk and volatility of both the business and the asset class or industry, is that industry gonna be here in 10, 15 years? The dependent on the owner or the person running it, and that exit potential. This drives multiples sky high. If you hit those marks, or at least a lot of them, you can create tremendous value. When I'm looking at opportunities or businesses, I'm focused on a few things. First of all, owner dependence. The overall market, the revenue type, and yes, its growth rate, but there's a lot of things that businesses could be doing that are not allowing it to grow that I can fix. And really, that's the key. From my list of factors, what are the factors that I cannot change? And what are the factors that I can? If I can change those factors that are driving it to have a low multiple, then I have an amazing opportunity to buy a business at a low multiple and increase it to be worth a ton of money. This has been my business model with all the businesses that I've started or acquired. It allows me to look at a company and analyze it quickly. We'll actually give you my spreadsheet as a quick analysis. Then you can practice, go online, talk to business owners, and use the actual graphic and chart to say which ones does this have or not? And which ones make this business dangerous to buy or full of opportunity? You'll be shocked how it changes the way that you look at companies, and you will be able to find opportunities that others are missing. I want you to take this, and also guys, let me know what businesses, sectors, or type of companies are you looking at and you want to get into that can actually grow it, as well as go to the Instagram and see the case studies, which we'll be producing more and putting up more long form of companies that I've actually bought, why, and how we've increased this value. Like and make sure you guys subscribe so you can actually see those case studies. Thanks again.